If the Federal Reserve wants to stop inflation, wants to lower inflation, like they say, they need to lower interest rates, not raise them or keep them where they are. Over the past few years, the Federal Reserve has increased rates. This is pretty common knowledge. They brought the Fed funds rate sits at between 5.25% and 5.5% right now. And housing, which is the largest metric of the CPI data, both in core CPI and in the headline CPI that the Federal Reserve tracks, housing is the largest metric in there. And housing, when interest rates are high, builders can bring less properties to the market. So the supply issues that we're having in housing throughout most of the country right now could be alleviated if interest rates dropped, if more sellers listed their home and were able to move. That would free up more housing, which would put downward pressure on both rents and property prices in the long term. In the short term, we might see upward pressure on property values, particularly because more people will jump into the housing market as affordability increases. But in the long term, this will bring stability to housing, which should bring CPI down. So we're going to get into all that in this video. But before we do, my name is Liam O'Reilly. I'm a realtor here in Vermont with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. Feel free to reach out to me directly. And let's get right into it. So this first article out of Yahoo, housing's outsized role in the Fed's inflation problem. So they talk about the different weights between PCE and CPI. So PCE is the production inflation. So this is the inputs going into consumer goods, not necessarily the final products, but what's used to produce those products. So in March, for the February PCE numbers that we got on Good Friday in March rose by 2.8% over the year prior, where CPI rose by 3.8% over the year prior. And when you look at how housing is weighted into these two metrics right here, in CPI, housing costs are about 43% of the core measure. For PCE, housing costs are 17.5% of the core measure. So as of February, CPI housing costs were up by 5.9% year over year. PCE housing costs were up by 5.8%. So a relatively similar increase in housing CPI and PCE costs, but housing CPI costs are weighted much more towards affect the overall number much more than the PCE costs do. So, and we can see that here in the CPI data. We have down here the core, this all items less food and energy. This is the core inflation number that the Federal Reserve looks at. And this housing number, the shelter, makes up 36% of that 80% core number that the Federal Reserve is tracking. And we see some of these other items in here. Of course, there are some that are high, like tobacco products are up 7%, but there's some that were very flat year over year. Apparel, flat. Commodities, less food and energy, down 0.3% month over month, or year over year, excuse me. Used cars and trucks down 1.8% year over year. Medical care commodities, they're right around 3%. So there are a lot of these metrics now, and there are other metrics that are way up, like motor vehicle and maintenance repair are up 20%. But again, that holds much less weight than housing. The motor vehicle repairs only hold 1% of the total weight into the headline CPI number that we all see. So because the Federal Reserve is keeping rates high, it's keeping sellers in their homes because of the lock-in effect, because most sellers have locked into a lower rate, which means there's less housing available on the market. There's not much inventory right now to buy or to rent. And I think if they dropped interest rates, more builders would bring more homes to the market, more sellers would sell their homes, which would free up more inventory across many markets in the United States, and would help stimulate and alleviate this housing problem, this housing crisis, this shortage that we're having across the country. But instead, when rates are high, that puts downward pressure on housing movement, on housing productivity. Builders can bring less products to the market. If it's rental properties, it's tougher to bring rental properties to the market because it's harder to make the margins work with higher interest rates. If interest rates were lower, it'd be much easier to finance a new build and make the numbers work for investors. So I personally think that if they drop rates, it will be better for overall inflation and housing inflation moving into the future. But instead, the Federal Reserve is losing rates, and they're actually losing money. They posted their biggest loss on record here, $114 billion in 2023. And this is the first negative year that they've seen. We have this chart down below here, but they go over the data right here. The Fed's audited interest expenses for banks' reserve balances hit $176 billion last year, and that's because of how high interest rates are. So the Federal Reserve keeps bank reserves. Their banks and financial institutions are required to keep reserves at the Federal Reserve, and those reserves are paid. The interest on those reserves is paid directly to these institutions by the Federal Reserve. So this isn't interest that's earned from money that's being lent out into a productive economy. This is just money that's sitting at the Federal Reserve, and these financial institutions are incentivized to keep their money there. And they're required to, but they're incentivized to keep more money there because of how high the Fed funds rate is. It's a risk-free overnight 5.25% to 5.5% that they can get just by putting their money at the Federal Reserve. And so essentially what the Federal Reserve is doing is they're making things harder on consumers. They're making things harder on housing. They're trying to slow down the overall market while they're giving money and essentially stimulating the banking system, because this is really free money. This is a risk-free investment, an overnight investment that the Federal Reserve is just giving to these banks and these financial institutions to increase the size of their balance sheet. Now, it's not given evenly, because if banks don't have enough reserves to cover the requirement that they need to have in the Federal Reserve, then they have to borrow from other banks, and they borrow at the Fed funds rate, at that 5.25% to 5.5% that the Fed has set as their Fed funds target. Now, this is part of the reason why economists are warning of a banking crisis, is because some banks are in trouble. The Bank Term Funding Program just ended in March, which this was a program that the Federal Reserve enacted after the Silicon Valley Bank collapse, which allowed banks to sell their bond portfolios, their treasuries, to the Federal Reserve at face value, at what they bought them for, not at the market value, which has gone down as rates rise. Because as rates rise, bond prices fall. And so many of these banks don't have the reserves they need in terms of treasuries and other government bonds that they purchased in years past, because yields have risen and the prices of those assets have fallen. And so without this Bank Term Funding Program to give them face value for those properties, they'll have to borrow from the Federal Reserve, from other banks, to meet their reserve requirements. So really what we're seeing here is this could cause a banking crisis moving into the future, which might be the catalyst that causes the Federal Reserve to drop their rates, which I think is the ultimate thing that will help CPI moving into the future. It really seems like, even though the Federal Reserve has gone out and stated that their goal is to fight inflation, to fight CPI, and that's the reason why interest rates are where they are as high as they are now, it seems like they're really gearing up to put these banks who are struggling potentially out of business, especially with the commercial loan crisis that has been looming for a couple of years now, where the assets of these commercial properties have been diminished because of the work from home craze, and because the cap rates are it's tough to make the valuations work at current cap rates based on where interest rates are right now. So a lot of these smaller banks are struggling. Meanwhile, banks that have lots of reserves can make a good return, not putting their money into the economy or into the stock market, or lending it out to small businesses, but just keeping it at the Federal Reserve, where it's not doing anything. It's not doing anything for the US economy. It's just they park it there and they get paid for free, essentially, for not taking on any risk. And so when the Federal Reserve drops their interest rates, these banks that have excess reserves at the Federal Reserve will be incentivized to lend their money out into the economy, to lend it to businesses, to lend it to builders who can bring more housing to the market, which I think overall will create more productivity in the housing market in particular, which will bring the CPI data down. So I know I was kind of all over the place with this video, but I hope you got something out of it. Let me know what you think in the comment section below, and I will see you guys in the next one.